couple
And,
of years.
and what do you hope to do with that space?
Well, we'll build a major office building, which we will take about 25%. It's probably one of the premier pieces of real estate in the city.
Mm-hmm.
We already have extraordinary interest, 2.5 years out for
Right.
leasing the rest of it. So it'll be the headquarters for everything in this part of the empire.
So even though PNC it was interesting because this is such a glimpse into where banking is right now, had a 42% drop last year. It was actually a better year than you expected.
Well, the 42% drop, we sold. You have to explain that.
Yes, I do want you to.
Well, we sold. We owned a company in New York called BlackRock,
Right.
which is arguably the world's largest and best fixed income. We sold 40% of that for $17 billion. We couldn't replicate that $17 billion this year, so that's the reason we were down 40%. The operating earnings were off just 2%.
Right.
But we sold. We still own arguably another $20-25 billion investment.
Well, the big enchilada of the bank felt this was a positive report. I mean,
This was a 2007. Given what's going on in the industry,
right.
I'd take it and not show off the
and that's
rest
my
of
point.
2008.
Given what's going
Right.
on in the industry, you
Right.
guys are looking good, which is making you attractive to Chase. And do you think
I
that will
hadn't heard
happen? You hadn't heard that there's some talk that.
I read about it, but
What do you hear in the lunchroom? Do you want to tell us something here that?
it has been the position of this company and still is the position of the company that we do quite well, thank you, and we continue to remain independent.
You're going to keep on keeping on.
Keep on keeping on.
One of the reasons that you have, that you did have a good year is that you weren't as deeply into the mortgage mess as other banks have been. And why is that? Why are you so lucky?
We don't own a mortgage company. We did have a mortgage company at one time. It was in Louisville, where I came from.
Mm-hmm.
I ran it at one time, and it was not the high point of my career. It's a very difficult business. We got out of it because it is too volatile and it's too mercurial. In essence, what you're doing is you're taking liabilities that you don't own and matching them with assets that you don't own, and either doing the servicing portfolio or trying to sell them off in the secondary market. Every month, you have to mark that whole portfolio to market. So it's a very difficult algorithm to do constancy of earnings by doing that. So we sold it. We sold it to WAMU, Washington Mutual, 5 or 6 years ago. So we're not in the mortgage business except for our customers.
Okay.
If our customers need a mortgage, we'll make the mortgage, and very often we'll keep it on our books. So it's our money, our credit. We are interested in them having it repaid. If you're a mortgage broker that makes a mortgage and sells it in the secondary market, it's a commodity business.
Right.
If it gets repaid, it's not your deal. You got a fee for doing it. The mortgage broker's got a fee for putting it together, and the investment banker's got a fee for bundling them and selling them off to somebody. So the incentives are non-ownership and non-equity. The incentives are take your transaction fee and move on. As we have seen in the last 4 to 5 months, it is a volatile and very difficult business. It is the risk-adjusted return is, in our judgment, not worth it, and we have been proven correct.
But you've been touched by it though, and
We had
in the commercial area.
we had some, like most people in the country, we had some exposure to the mortgage-backed securities investments in short-term investments. So we marked some of those down in the fourth quarter, pretty modestly compared to most of the, less than $50 million. And so it's a pretty modest exposure, but we're fairly immune from it. What we are not immune from, and what everyone in this room is not immune from, is the fallout of all of that and what it does to the economy, confidence, credit markets, et cetera, et cetera. So, with the decline in the pall over the markets and the psychological impact of reading about $10 billion losses 2 or 3 times.
Well, the debate at least in the financial media this week is virulent on the subject of whether what the Fed did was the right move and whether a recession can be avoided. Where do you come down on that? Do you think that the actions that Bernanke has taken have been the right actions, and do you hope to see more reduction coming out of the Fed, or do you think that we're in a good place now, this is where it should stay?
I'll report to you what I think.
Yes.
Not the company.
That's why we have you here.
Yeah. I worry about the Fed responding with a goal of keeping the stock market up. That's a fairly narrow goal. Obviously, they wanted to avoid some what appeared to be worldwide anxiety that was
Right.
spiraling, so it was a confidence thing. My definition of what the Fed did was they put a tranquilizer in, not an antibiotic.
Big difference.
So they calmed everything, but they fundamentally, what they did will trickle down into the economy, not immediately. It's like when something happens in the Middle East on Connecticut Avenue, the gasoline goes up the next day.
Yeah.
You kind of have a hard time with that. And I think what you're seeing is the Fed will have a moderate effect 60 to 90 days from now. Immediately won't change anything. But it was a psychological prop. So the question you have to ask is how important is it for the Fed to do that? How important is it to use monetary policy to upgrade everybody's psyche? They wouldn't have done this 20 years ago, not because the circumstances weren't the same, but what they would not have done was everybody didn't have their own stock, everybody didn't have a 401k.
Right.
So now the stock market is a populist thing more than just an investor thing.
Yeah, it really.
And so they really get anxious about that. When you see your home price going down and your 401k going down, they're worried the consumer will quit spending.
Do you think this is a move Greenspan would have made?
I have no idea.
Want to guess? I mean, do you think Bernanke's out there? Do you like what you're seeing from him, or
Well,
are
they,
you
they see
reserving
things
judgment?
we don't see.
They do.
They see, let's remind ourselves that the whole issue is about whether there's a recession. A recession is too...
That is the major issue.
Well, probably not. A recession is 2 sequential quarters of a down economy. That's a metrics issue. If you're got an arm that's repricing at double, or if you have a house you need to sell because of a divorce, or you're changing jobs, or whatever, a setback in your job loss, your house price is more important than anything else. So it's a very personal decision. Who cares whether there's a recession if it doesn't affect you? And a lot of people are unaffected by it. The earnings that are coming out of companies in the first quarter of this year for last year, 60% of the earnings are up. So it's a very targeted problem of the financial services industry, the mortgage markets, and how that affects people.
Yeah.
Their job, if they work for a great company around here, they may be fine, but their house is upside down by 10% because it was overbuilt. We had too many houses because people moved into homes as investments, not in residences.
Yeah.
Bad mistake. 40 years of California and other places will teach you that never works. And so there is an enormous adjustment going on for people who speculated in homes, and it was fueled by some irresponsible mortgage lending. So the combination of the double activity meant you've got people who can't afford the repricing of the ARM, and their house, because there's too many homes on the market, is underwater. They have a problem, but their job may not be a problem.
Their job will be secure. But I was reading somebody who said that a recession could possibly be a good thing, like a spring shower, and then we get out of it and we reform.
Well, we've become intolerant of the fact that the economy is cyclical.
Yeah.
It's an adjustment. It has adjustment. Stock market goes down, stock market goes up. I mean, the headlines will say the stock market had a horrible day. It was down 500 points. Well, 500 points on a 12,000 stock market is not as bad as 200 points on an 8,000 stock market 6 years ago. So it's a little bit of attention-grabbing headlines about that. So, if you've lived in this industry and is old like I am, you've seen enough cycles and you've seen enough of it to know this too will pass, Lord. And people will get hurt. The tech bubble, we all survived it, and we lost more net worth in this country then than we're losing right now. So it'll be okay. We just have to kind of live through it and hang in there.
It's telling that to the people who are getting really seriously hurt. That's the
Well, there's enough blame to go around with everybody. There are people